We had a phenomenal week in the market with the majority of stocks in the S&P 500 performing very well, and now we can see the expectation by the market is that we are getting our first interest rate cut in September, and that is something that essentially has come due to the fact that the inflation levels have been coming down. We saw just last week that the annual rate was 2.9%, and that is the lowest it has been since March 2021. Now today we are looking at 5 undervalued stocks below $50 that we believe will perform very well when the interest rate cuts start to take place. We're going to look at each one in detail. We're also going to take a look to see how they performed in the last few quarters in terms of the earnings, expectations moving forwards. We'll talk about their dividend safety, look at some very important underlying metrics, their debt levels, their free cash flows, and as always, we're going to run each one into the valuation model, talking about our own intrinsic value, our margin of safety, as well as what Wall Street are expecting over the next year. So the first one we're looking at is a REIT, VICI Properties, a real estate investment trust, where we get a triple buy rating, seeking alpha, Wall Street and quant. This one does trade in the mid to upper end of the 52-week range, with a nice yield, 5.23%, that is paid quarterly, and as we mentioned, with rate cuts coming, they will massively benefit companies in this sector, and we expect a lot of money that is on the sidelines in saving accounts to come into these REITs like VICI Properties, Realty Income, Extra Space Storage, just to name a few. The P to FFO, well, it does sit at just above 12, and we can see over the last year it is up around 6%. Over the last 5 years, up 52%. And in fact, if you are a regular viewer on this channel, you would have seen us do a few deep dives on this company when it was at its 52-week low, and we were buying pretty much every day over a fairly long period. Now, in terms of how they've performed over the last few quarters, we always like to see this to give us some faith and confidence in the projections moving forwards. For VICI Properties, while they did beat in their more recent quarter, however, what we do notice is 2 beats and 2 misses, so a 50% track record. The next quarter, they are anticipating some very strong double-digit growth on a year-on-year basis, and in fact, out of the next 4, 2 of them are decreasing. However, over the longer term, they are expecting FFO, funds from operation, increases, lowering that forward P to FFO to around 11.71. Now, in terms of the actual company, the underlying metrics, starting off with the dividend safety, a 50 score borderline safe, so we can look at the reasons why. Dividend growth, while 6.4% in September, one of the nicest REITs in terms of their growth at some very strong levels. That is above 4% inflationary level we want to see. And we also know, given the increase last September, we are anticipating an increase over the next few weeks. Now, what does this mean? Well, firstly, it was reaffirmed just 2 days ago that it does sit at a borderline safe level, and it suggests a moderate risk of a dividend cut over a full economic cycle. Now, when we take a look at some of the metrics, the first one, as we said, nice increase just last year, but look at that, over the last 5 years, double-digit increase at 10%, which is very strong, not only giving a nice yield of over 5%, but also a nice growth rate as well, and they have been increasing those dividends for the last 5 years from when they started to pay them out. Now, in terms of looking at dividend yield theory, for those that are new, it does tell us a company is undervalued when the current yield sits above the 5-year average. So this is an undervaluation signal. 5.25% yield, 5.04 is the average over the 5 years. And we also note the forward P to AFFO, adjusted funds from operations, also sits lower, 13.8 than the 5-year average. So that is a double undervaluation signal. In fact, make that a triple given the fact that real estate as a sector does sit higher at 14.6. Now, in terms of the payout ratio, typically on this channel, we draw your attention to the free cash flow due to the fact that earnings data is susceptible to manipulation by management through accounting. However, for REITs, we do focus on the AFFO payout, given the fact that free cash flow a lot more volatile. Now, below 75% is our preference for hotel REITs, pretty much straddled around that year on year, 73% expected over the next 12 months. So actually, over the next few weeks for VICI Properties, we are anticipating a nice increase above inflation. We would be surprised if it is anything lower than 5%. Adjusted FFO per share, similar to how we look at the free cash flow for other companies, we want to see consistent increases over the longer term, something we see, and in fact over the next 12 months it is anticipated to continue the upward trend to 228. Then we move on to sales growth, where for REITs we want to see 5 to 10%, something we do get over the last few years at a very rapid rate, in fact 36% over the last year. But one of the main things we also want to point out here is the AFFO per share growth. This is one of the key metrics we need to look at, and what we can see out of the last 4 years, double-digit growth at 11%, and over the next 12 months we are expecting a little bit of a slowdown to around 3%. And then when we take a look at the numerics, what we can see here, around 900 million in 2018 to 3.6 billion in the latest report. Now, shares outstanding, for those that are regular viewers, you will know this, but for those that are new, in terms of REITs, they will dilute your position at a very rapid rate. Reason for this, well, they don't retain a lot of that cash flow as they pay the majority out as dividends, and you have to bear in mind some REITs will dilute your position quicker than others. VICI Properties, as we can see here, one of those that do dilute it at a fairly rapid rate, but as long as the company is growing, the AFFO per share is also growing at a strong rate, then that is probably something that you could live with. Now, ROIC, very important metric. We want 3 to 5% for REITs, 10% plus for other companies. Give us faith management are able to effectively allocate their capital. Very strong numbers that we see here for a REIT, between 5 to 8% just over the last few years. So we do love to see that. That does give us faith about management. And when we do focus on the operating margin, it does look very strong, although fairly inconsistent, still at a very high and reasonable level. Finally, the net debt to EBITDA, and probably the one that is one of the most important for this company, as it correlates to both dividend safety and balance sheet strength. As we just saw, it does hit a borderline safe score. That is because we want to ideally see below 3.5 for hotel REITs. Now, for other REITs, if we're just being general, then we look for around 5.5 as a maximum. And what these numbers below show us are the number of years it would take the company to pay off all of their debt net of cash on hand. Now, 5.86 is significantly higher than the 3.5 we want to see for this industry specific. However, when we look at it overall for just REITs at 5.5, it isn't too far off. The nice thing to note here is from the highs of 2022 at 6.46, it is down in 2023 and anticipated to come down further. So it is moving in the right direction. The FFO payout also looks reasonable at 73%. So this is one that we don't have any issues with in terms of the dividend, but something that over the next few quarters and when the annual report is released, we can take a deeper dive just to ensure that these numbers continue to come down the right trend. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of VICI Properties at $39. The reason that we got to this was through the 3 different models, the average essentially, and typically on this channel we run through every single model. Today we're getting straight to it. Now with the current price at $31.50, we always add a margin of safety and we start off at 10% and execute on that if it meets our 3 golden criteria. A wide moat, strong financial metrics, good forward-looking data, and then we keep going till it's near the current trading price to understand in today's episode that is pretty much trading at a 20% MOS level. Now we do believe this is still fairly attractive. Obviously, when it was nearer the 52-week low, it was even more attractive. But the one thing to understand here is with the expectation of interest rates coming, then we do believe that will severely benefit not just VICI Properties, but also others in the real estate investment trust sector. However, we have picked this one today. It is below $50. It does have a nice margin of safety, and we can also see not just a triple buy rating from Wall Street, Seeking Alpha and Quant, but also 14% upside, price target of $36, and one that we do believe right now also has a fairly attractive yield that we saw was also undervalued on dividend yield theory. Before we move to the next one, just to let you know, we have released our latest free weekly article. If you want access to this completely free, you can click on the pinned comment below to read and sign up straight away. We've also released our 35 undervalued stocks for the month of August, where we also talk about those that sit within our own portfolio and those that we do believe to be attractive, so do go check that out below. The next stock we're looking at is Kroger. Now this one is slightly above $50, so do excuse us, although we thought it is just $3 above. It is a very strong company and a very nice dividend growth that we will show you shortly. A double buy signal with a hold from Quant. It is trading in the mid to upper end of the 52-week range. Now when we did cover this not too long ago, it was towards the lower end and we did believe this was a strong buy. In terms of the yield, well, 2.42%, and in terms of the forward P, sits below 12. Now, just for context, S&P right now sits around 23. Over the last year, it is up around 13%. Over the last 10 years, up around 110. We do notice all-time highs sitting right there on April 2022 at around $62, so it isn't too far off. Now, in terms of their earnings, always great to see a company that has a 100% track record over the last 4 quarters. Gives us faith when we look at their next 4 to see that they should be able to attain them. Now, the next quarter anticipating negative growth, and when we do look out to January 2026, the forward P is estimated to hit around 11.7. Now, what about the underlying metrics? Well, look, we have a safe score here at 71, and as we will show you, very strong increases to the dividend, 10% in fact just over the last few months. We love to see double-digit growth on this channel. Now, we do notice here it was reaffirmed in July. Basically, a safe rating means that a dividend cut is unlikely. And in terms of the last recession, how did they perform? The Great Recession 07-09. They in fact increased the dividend. They had above average growth, -1%, significantly above the -12 of the S&P. And they performed very strongly, -31% against the S&P's -55. As we mentioned, phenomenal dividend growth, 10% this year, 16% on average over the last 5, 14% on average over the last 10, and we can see 17 years of consecutive increases. We do believe this is a very underrated company, one that you probably don't really hear that much, if at all, in the investment community. Now, we also get an undervaluation signal on the yield at 2.41, and we also note the forward P is marginally lower than the 5-year rolling, and when we do take a look, much lower than the consumer staples sector, sitting there at 18. Now we can look at the free cash flow payout. We want to see below 60%. Give us that faith they can offer double-digit increases that they have done in the past. Below 60%, 8 of the last 10 years, 28% in 2024, 35% over the next 12. So we should be anticipating more double-digit increases moving forwards. We then want on the free cash flow per share, consistent increases over longer term. Now, granted, when you look from 2015, it is up more than double to 2024, but it is a bit inconsistent on a year-on-year basis, and we do anticipate a drop to the free cash flow over the next 12 months. Now, sales growth, we want to see 3 to 7% year-on-year, just at a minimum, keep up in line with inflation at the 3 to 4% level. Very inconsistent, in fact, just 1% in 2024, but when we do zoom out, we can see nearly 50% growth from 2015 to 2024. What we love about this company, not just the dividend growth, but they also return excess cash through some significant share buybacks over the longer term. Fairly consistent, although we do note over the last few years they have started to slow this down, but always a great bonus, especially when they do offer those strong dividend growths that we have come to love with Kroger. Now, in terms of return on invested capital, as we said earlier, 10% or more for other companies, and that is what we get pretty much every single year, and it has been increasing from the lows of 2020 to 15% in 2024. In terms of margins, both on the operating side and free cash flow, well, look, it isn't something they have been able to attain when we want above 12%, but when we do look at this industry as a whole, even when we look at the likes of Costco, Walmart, they have very, very similar margins, very small, so something just to bear in mind when we do compare it on a sector basis, and the same to be said for the free cash flow. Ideally for this, we want to see at least 5%. Then we finally get to the net debt to EBITDA, below 3 for the majority of companies, and it's come down from the highs of 2019 at 3.72, 2.01 in 2024, expected to go lower in 2025, so it is a very positive sign. Balance sheet does look good overall, and as we just saw, the dividend does look to be safe, and we do love those double-digit increases. Now, the intrinsic value in today is $63, and as always, you can grab a copy of this model if you want to run your own numbers through, whether it's for Kroger or any other company. Now, before we look at margin of safety, we can see Wall Street do have a price target of $60, not too far off our intrinsic value, where they do see 13% upside. Now, MOS at 10%, as always, remember we use that as a bare minimum, a buy at $57, and in today's episode, you're getting at least a 15% MOS at $53.44. Now, for those that are interested at a 20% margin of safety, that would be pretty much around the $50 mark, which we do believe is good value for this company that we see over longer term performing very, very well, especially with the interest rate cuts that we do see coming over the next few months. So in conclusion, for Kroger, 15% MOS and in fact 13% upside from Wall Street. And as always, do give us your thoughts as we go along these companies today. The next one we move on to is Pfizer. Now we have a double buy and a hold from Quant. This one, bear in mind, has a very attractive yield at 5.85%. And as we said, with interest rates coming, we do believe a lot of these companies will be incredibly more attractive. Their prices will rise and we will see their yields come down. So do try to take advantage of any companies you do believe look good over the longer term. Forward P around 11. It is trading at the mid to lower end of the 52-week range, down around 20% over the last year, and over the last 10 years it is up only 5%. As we can see here, COVID highs around $60 nearly 3 years ago. Now, in terms of their earnings, always great to see they have beaten 4 out of 4, so 100% track record, and we do get some inconsistencies moving forwards, although it is anticipated still over the longer term to rise, and that forward P to come down to around 9.88. Now, when we look at their dividend safety score, it does sit at 75 safe, and we can see the growth fairly mediocre. As always, we want to see a minimum of 4% just to keep up in line with inflation. And when we do look, in fact, at the recessionary metrics, they did cut the dividends, so something to be aware of just if you believe we are heading into another one. Negative 6% in terms of recession sales, still above the average, and they also marginally outperform the S&P, negative 45%. Now, as we mentioned, it is trivial increase below inflation, but over the last 5 years, you are getting at least an increase in line with inflation. Over the last 20, marginally higher at 5%, and they have been increasing those dividends for the last 13 years. Now, in terms of dividend yield theory, no surprises. We do get a double undervaluation signal with a very nice starting yield at around 6% and a forward P sitting below at 10.8, the 5-year rolling of 11.9, and in fact below the healthcare sector at 16.8, giving Pfizer in today's episode a triple undervaluation signal. Now, one thing that we would say about their free cash flow payout is that at 193% in 2023, that would have been a red flag indicator, as management would have paid out more in dividends than they generated in free cash flow. However, over the next 12 months, this is anticipated to come down to around 71%. So hopefully, at a minimum, for a very nice yielding company, we do want to see an inflationary 4% increase. Now, free cash flow per share, no surprises that it has increased sharply during the COVID era, and again, no surprises that it did decrease. The thing to point out here is that over the next 12 months, with the acquisitions they have made, they are anticipating 235, and in previous episodes, we have also looked at their pipeline, which does look fairly positive over the next few years. Now, in terms of sales growth, again, no surprises right across the board. They have some very strong growth during COVID. They had a massive drop in 2023, but the main thing to point out here is before COVID, we do see some very inconsistent and poor growth to their top line, something to maybe bear in mind, but the important thing to take away here is to look at the next few quarters and ensure the growth that they do see is in line with what you're expecting, especially as we mentioned with those acquisitions that they are taking on, as well as some organic growth that they do hope to have. Now, in terms of numericals, you can see 50 billion in 2014, in fact doubled to their highest point in 2023 before coming down very sharply. Now, we do know they have returned excess cash, in fact buying back nearly 1 billion worth of shares, but over the last few years, in fact the more recent time, it has been a lot slower and in fact not something they are looking to do at a major point in terms of their capital allocation from what we've seen in their investor slides. Now, ROIC, as we can see here, looking very strong over the last 10 years. It is down in 2023. No surprises when you do look right across their metrics that 2023 has been suffering. Again, this is shown on the operating margin, down to 9%, significantly lower than the highs of 2022. And even their free cash flow margin down to 8%, even though we do want to see a minimum of 5%, just disappointing the massive drop they've had. But also look at the share price, as you can see, this is all reflected in that massive drop. Now, in terms of the net debt to EBITDA, now below 3 is what we want. This is fairly important, especially for those companies that offer high yields. Now, 3.75 is above what we want to see. The key takeaway here, and something to ensure by looking at their next quarter results, as well as their annual report, that they are able to bring this down. 2.69 is anticipated over the next year. And if you are subscribed to this channel, we do always take a look at earnings from these big companies. Now, let's move on to the valuation of Pfizer. Now, our intrinsic value just under $35, around $1 higher than Wall Street at $34, but they do see 20% upside, and as we saw, they did give this a buy signal. Now, MOS, well, 10% a buy up to 31.37, at 15% around $29.63. And in today's episode, you're getting a near 20% MOS around the $28 mark. So that's a very positive sign if you do believe in the long term. In fact, whether or not you think over the longer term with the yield, it does look very attractive. So in conclusion, 20% MOS with 20% upside. Do let us know your thoughts. A lot of people do find this attractive, although some people do like to steer clear for Pfizer for obvious reasons. We then move on to CX Corporation, where we have a double buy signal and a hold from quant. This is trading in the mid to lower end of the 52-week range, a 1.43% yield with a forward P sitting at 17.3, one that we believe with interest rate cuts will massively help not just CXX Corporation, but also the majority in this sector as a whole. It's up around 11% over the last year. Over the last 10 years, significant outperformance of the S&P, up 226%, and we can see, in fact, all-time highs around the $40 mark just this year in 2024. Now, also nice to note, they have beaten 3 of the last 4, in fact, the more recent 3, so 75% track record, and 3 of the next 4 quarters, they are anticipating double-digit growth to the EPS year on year, which ultimately in 2025 will bring that forward P down to around 15.57. We have our first very safe dividend score of 85. Dividend growth 9.1% in February this year, so very strong at the high single digit point, and effectively very safe for those that want to know, means that a dividend cut is highly unlikely. Now, last recession, in fact, they increased the dividend. They did have below average growth, and they also marginally outperformed the S&P, negative 51%. As we said, very nice increase in February, but this isn't something that is irregular for CSX. 8% over the last 5 years, 16% over the last 20, and we note 19 years of consecutive increases, around 6 years shy from becoming a dividend aristocrat. We also get the double undervaluation signal, both on the yield as well as the forward P. When we do take a look as well, it is below the industrials, so in fact we continue with the previous company, another triple undervaluation signal. We also love their free cash flow payout because for the majority of the last 10 years, below 60%, in fact over the last 6 to 7 years, it has been looking very, very good, and that is one of the reasons why for this company, we do get to see those very attractive dividend increases, very similar to Kroger. And we also like their free cash flow, although fairly inconsistent. Over the longer term, we see massive growth, but do bear in mind over the next 12 months, it is marginally expected to decrease. Now, in terms of sales growth, you could argue this is a fairly cyclical industry. That is why 5 of the last 10 years, we have seen negative growth to their top line. And numerically, what we can see here, 13 billion in 2014, around 15 in 2023. So as always, have realistic expectations, because ultimately this isn't going to be a company like you see the likes of Nvidia, Apple, those tech companies that grow at a very rapid rate year on year. However, what we do see here is they return a lot of excess cash. They do a lot of share buybacks. In fact, one of the best that we have seen on this channel, they've bought back more than 1 billion shares over the last 10 years, something that is very underrated when you are looking at companies, especially those that do offer very good growth rates as well. ROIC looking very strong as well, consistently above that 10%, 14 to 15 over the last few years. And when we look at margins, one thing we haven't covered on this channel, because we haven't seen it yet from these companies, is operating efficiency. In fact, their margins has gone from 29% in 2014 to 38% in 2023, so very attractive to note. And free cash flow over the last 5 to 6 years, very strong in the 20s. We would consider this a free cash flow machine if they can keep this up over the next few years as well, just to get that consistency moving forwards. We then move on to the net debt to EBITDA, below 3 consistently, always a great sign. 2.44, expected 2.34 over the next year. So this is something very nice to note, and one of the reasons why we saw that very safe dividend score. Now, our intrinsic value at $41, not dissimilar from Wall Street's 39 target at 17% upside. And when we do run it through the MOS calculation, 10% a buy at $37, at 15% around $34.70, and in today's episode it isn't quite at the 20% level yet, sitting somewhere between 15 to 20% for what we do believe to be a very strong company, and probably one of the most that will benefit from those interest rate cuts that do seem to be looming. We then move on to the oil and gas giant BP with a double buy and a hold from quant. This one is trading in the lower end of the 52-week range, a very strong yield of 5.24%, and a fairly low PE of around 8, especially in this industry. In terms of over the last year, though, it is down 5%. Over the last year, down 29%. But as always, it does depend at which point you did purchase. And in fact, this doesn't include those dividends reinvested. Now, in terms of their quarters, how they performed, 3 of the last 4 they did either beat or in line, with the one they missed being Q3 of 2023. Over the next 4 quarters, 3 of them they're anticipating growth, with the next one being a decrease. Ultimately, if they hit that December 2025 EPS, the forward P will come down even further to 6.83. Another borderline safe score of 50, although we do note here very strong increase to their dividend just last month at 10%. And when we take a look at the last recession, they didn't increase the dividend. They also didn't cut it. They maintained it. They had below average growth significantly, in fact, at negative 39%, but they did outperform, although marginally, negative 45%. Now, as we said, nice growth in July, although bear in mind for oil and gas, we do sometimes see this where they do cut over the more recent period. Over the last 20 years, no growth on average, and we can in fact see only 2 years now of those consecutive increases. In fact, when we do look at the graph, we can see those points that they have had those dividend cuts. We have the Great Recession period as well as the COVID era. Now, moving on in terms of dividend yield theory, no surprises, we get that undervaluation signal on the yield, although we do note the forward P of 8 isn't too far off the 5-year of around 7.5. It is, although, noted that energy sector is much higher at 12.6. In fact, this is one of those in the sector that does trade at a very low forward P, but as we saw historically, it doesn't trade too much higher. Now, in terms of the free cash flow payout, for oil and gas, we want below 40%, something that we have seen over the last few years. Bear in mind, as we go along these metrics, this industry is very cyclical, so we will see a lot of peaks and troughs. In terms of the free cash flow as well, we do note here a lot of inconsistency. It is also anticipated to decrease over the next 12 months. And as we mentioned, the cyclicality coming through, 6 of the last 10 years have been negative growth. And when we do look at it from a numerical perspective, we can in fact see the top line has been decreasing, 351 billion in 2014 to the lows of the COVID era at 106, before in fact doubling from that point to 208 in 2023. Now, they have a lot of shares outstanding. They've in fact done quite a lot of both share issuances as well as share buybacks, although the net point over the last 10 years has been at least 1 billion worth of share buys. ROIC, then again, the inconsistencies is shown throughout today, up and down year on year, 28% in 22, 17 in 2023. So over the shorter term, it does look fairly strong. And in terms of margins, again, no surprises. Above 12% is what we want to see. Above 5% for free cash flow for this industry, and a lot of inconsistency throughout. In terms of the net debt to EBITDA, though, one thing that we do like to note here, the balance sheet does look fairly strong. Below 1.5 is what we want to see. That's what we get over the last 3 years. 0.52 in 2023, a small increase anticipated to 0.85 over the next year. Now, in terms of valuation, our intrinsic value of $44 pretty much bang on to what Wall Street see, and they have upside of 29%, making it one of the most attractive stocks today under the $50 mark. Yes, we know Kroger marginally higher. In terms of the MOS then, at the 10% level, a buy at $39, at 15 around 37, and in today's episode you are getting at least a 20% MOS up to $35. For those that want to see, 25% is around the $33 mark. So 20% MOS, nearly 30% upside over the next year with a very nice above 5% yield. Do give us your thoughts below. If you did enjoy today's episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter. We are dropping a new one every single Monday, so that will be coming soon. And also do join us in the Patreon below if you do want to discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.